Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you insight onto everything mutual fund related, and it is a good month for the mutual fund industry. In fact, it's been a good couple of years, and that culminates in the month of July, where you've had once again a new record high for the gross inflows through systematic investment plans. That has stood at the month at a number of 23,300 crore or thereabouts. And if you actually go past last year, the start of this year, all the way to July of last year, every single month since July of 2023, we've had a fresh record high with regard to the gross inflows. All told, the numbers actually look very healthy. If you look at the gross inflows into, or rather the net inflows into actively managed equity mutual fund schemes, for the month as a whole, it's come in at 37,000 crore rupees. And despite the slight decline, it's quite a significant number nonetheless. Last month was 40,000 crore rupees because the inflows into thematic and sectoral funds was even higher than it was in the month of July. And in the month of July, that number stood at 18,386 crore rupees. As a result of which, the assets under management in sectoral and thematic mutual fund schemes, which number 174 and is by far and away the largest category in terms of the number of schemes, it is also the largest in terms of assets under management, which at the end of July stood at 4.21 lakh crore rupees. Till the month of June, the flexi cap category was the largest, and as of July, that category has 4.2 lakh crore rupees. It saw inflows of about 3,000 crore rupees. New fund offers continue to account for a large bulk of the inflows, and that stood at 13,735 crore rupees into actively managed equity mutual fund schemes. There were 3 new schemes that were introduced. Now, we are going to talk about this and a lot more on today's program. In fact, today we are focusing on a highly effective investment strategy which has to do with the withdrawal. You've heard of SIPs, systematic investment plans. They allow you to invest into mutual fund schemes. But there's also a systematic way of withdrawing money, and that is in the way of a systematic withdrawal plan. It turns out that this is actually a very tax efficient manner of pulling money out, particularly if you are a retiree. We'll talk about why that is and a lot more. And joining me to talk about all of this is Udayan Adhe, who's the founder of Udayan on Money, as well as Shalini Sekhri, who's the Chief Growth Officer at Renaissance Investment Managers. Thank you so much to the both of you for taking the time. I'm first very curious what you make of the latest AMFI numbers, and hopefully you've got a sense of what I was saying on the screen. Of course, I wouldn't expect you to go into the absolute details of it, but just the fact, Shalini, that the sectoral and thematic category is now the largest in the actively managed equity mutual fund space. It has been growing very substantially. But what does that tell you about the nature of the investments that are coming through in the equity market and into mutual funds?
Hi, Alex. Great to be here as always. So I think we're seeing this huge trend of investors looking to increasingly diversify their portfolio. Most investors today have, all the basic categories, and there is so much news flow and there is so much information available to each of us in terms of the themes which are doing extremely well. So as you know, the buzzwords have been around, defense, consumer. There have been a whole lot of these themes which have been talked about so much and which have, caught the fancy of the retail investor. And that is translating into flows and of course aided by a lot of interesting NFOs as well, which we have seen in the market. So clearly, I think it's a way of investors to put bigger bets on themes which clearly we're all seeing in our day-to-day lives are going to be decadal themes. These are not 3-month, 6-month themes that are playing out. Many of these themes we intuitively know, whether it's electric vehicles and a whole bunch of them, are here to stay. So I think as we learn more and more, as our investors get more and more sophisticated, I think somewhere there are a lot of calls being taken that in addition to diversified portfolios, should we also look at adding a little bit of extra firepower, through thematics? And I think that's what we are seeing playing out here.
Okay. Udayan, what's the kind of advice that you generally give people on sectoral and thematic funds? Because, of course, in the recent past, we've seen thematic funds being offered which allow for a wider basket of mutual fund, a basket of stocks to invest from. So the pool available is larger, but sectoral funds tend to be very narrow in nature. Generally, when you tell people about sectoral and thematic funds, what do you tell them?
Yeah. So first of all, thank you so much, Alex, and good afternoon to everyone. Shalini opened a new office in Mumbai, so congratulations to you as well on that. And with your question, Alex, I think so. What Shalini mentioned, right? If you can add a slightly, if you can add a small allocation using thematic or sectoral funds to add that small firepower to the portfolio, that could be a good idea. But what I'm seeing more and more when I'm talking to people, when I'm guiding them on mutual funds, and I'm having conversations around them, is that people want to invest a large part of their entire SIP investment or their entire portfolio into thematic or sectoral funds. And I think that can be a slightly tricky proposition because then you're too concentrated in one fund, and then your risk to that one fund, for various reasons, it may fluctuate, and then your risk in that portfolio goes up. So the general advice, the thumb rule is to have, if you're investing in thematic funds, sectoral funds, limit your investment in them to about 10 to 20% of your portfolio. And that would just ensure that you get that small injection of growth that if that sector does well, your portfolio would benefit from. But at the same time, if that sector does not perform well, is stagnant for a few years, then it doesn't affect your overall growth that you're keeping in mind.
Yeah, that's a fair point. All right, let's jump to the main topic of conversation today, which is SWPs or systematic withdrawal plans. It's not something that's very popularly known. SIPs now is a byword, even when you talk about mutual funds. Often people confuse the two. Are you doing SIPs? Are you investing in SIPs? But they actually are talking about mutual funds. But talk about how this can be used strategically, Shalini. Why is this such a powerful tool?
Right. So I think the same benefits which accrue from doing an SIP in the same way works exactly the reverse, but with the same set of advantages when you're actually looking to create an alternate income source, either like you said, for retirees as they grow older, their regular source of income stops, but they have a certain lifestyle and they want to continue to be able to fund that. You could also have situations where people need more than what they're currently getting out of, say, their regular salary, and they also need the secondary source of income. So that's where the pool of capital that they've built up through disciplined investing over the years, once they've built a corpus, they can then specify a fixed amount, just as you do in SIP, but not to invest, to withdraw from their existing corpus. This allows them to have a fixed amount which will come to them at whatever periodicity they decide. So it could be monthly, quarterly, or annual, where let's assume that this is monthly, right? So there is a particular NAV of a scheme that they have chosen from which to withdraw. At that NAV, to ensure, let's assume they want 25,000 rupees a month, the NAV would then result in how many units do they need to redeem to be able to get this money out. So irrespective of where the markets are, where the NAV of their portfolio is, they can rest comfortably that this 25,000 rupees will come to them every month, and the number of units required to be redeemed will be redeemed to create this cash flow. There will be times where markets are doing well, fewer units get redeemed. There will be times where markets are not doing as well, and more number of units would need to get redeemed. But this would not in any way impact their lifestyle because they would continue to get this 25,000 rupees every month. So that gives a great cushion to investors to be able to manage their monthly flows. And this is particularly critical for retirees. So that's really the mechanism of SWP.
Do you have anything to add to this, Udayan, in terms of the alternative? Because a lot of people, when they are in that bracket, when they're in that retired bracket and they're looking for regular income, oftentimes they look towards interest income or they look towards dividend income. Why is this something that should be considered as opposed to that?
So I think having some amount of equity exposure, even for a retiree, is extremely, extremely vital. Because if you think about it, the kind of inflation numbers that we look at, that the government reports, those are for day-to-day items. But for most people who are spending more than 50, 60,000 rupees a month, the inflation tends to be 8 to 10%. So now, if that is the case, your investment needs to generate much higher returns than that 8%. And the only way to do that is by adding some equity to your portfolio, which provides that growth injection. And one of the most popular ways to add equity exposure to a retiree's portfolio is by using balanced funds or hybrid funds, which invest both in stocks and bonds together. So your overall risk kind of goes down, but at the same time, you get that equity exposure. And by just having this in place, it becomes extremely vital to make sure the money lasts. Because think about it from the retiree's perspective, right? Money has stopped coming in, or it's coming in at a smaller quantum now. So they need that money to last for 20 to 30 years at least. And at the same time, just to give you an idea as to the inflation that would kind of impact future future withdrawals, right? So, for example, if today you are withdrawing 12 lakh rupees every year, so that is 1 lakh rupees per month, then even at an 8% annual inflation, the withdrawal amount would double in just 8 to 10 years. So instead of withdrawing 12 lakhs, you have to withdraw 24 lakhs 8 to 10 years later to be able to buy the same level of things. So inflation has to be factored in. You have to beat inflation, and the only way to do that is to have that equity exposure in your portfolio.
Okay. What is the ideal amount to look at, Shalini? Is there an ideal amount? Because if you're talking about a pool of resources, assuming we're talking about an equity mutual fund basket or portfolio, you are withdrawing from that, but you want the capital to grow as well. Otherwise, you're going to impact the compounding of that basket. So is there an ideal to look at?
The broad thumb of rule, Alex, would be that the rate of withdrawal should be less than the rate of return in your portfolio, right? So that way the capital does not reduce. This is particularly important when nowadays, people are living so long, you don't really know how long your retirement's going to last. And as we discussed when we spoke last time, people do want to leave a lot of that capital behind for their children as well in terms of legacy. So if you want your capital to stay invested, irrespective of type of scheme, and grow, it's very critical, firstly, that you build up some decent sized corpus before you start withdrawing. If you are a conservative investor where, say, a lot of your portfolio is in either debt or shorter term funds, a safe thumb rule would be maybe withdrawing about 6-7% every year. If that portfolio is more like a equity oriented or a mixed kind of a portfolio, probably 8 to 10% a year is something that one could look at, because that's expected to be the rate of return from the portfolio. So if you, for example, if I had looked at the last 10-year data, if you had withdrawn, say, about 8% from an equity portfolio, of course, you would have got that income, but your portfolio would have still doubled in those 10 years because your capital is staying in and continuing to grow, and you're not pulling out the entire gain. But that is more anecdotal because equity markets have done so well. You could also see the other cycle. So I would say for an equity portfolio, probably somewhere an 8% withdrawal should be good.
Okay, all right. The other aspect to factor in is the tax aspect, and of course LTCG rate has gone up to 12.5% from 10%, and the first 1.25 lakh of course is non-taxable. But Udayan, the factor of first in, first out is something that comes into play for systematic withdrawal plans as well. Can you explain the tax aspect of using SWPs?
Absolutely. So generally, when you're investing money in, say, an equity fund or a balanced fund, which, as I said, invests both in stocks and bonds, the usual thumb rule, which may not be applicable again in every situation, is to ideally not withdraw from it for the first 1 or 2 years. So you let that money grow a bit. But now let's say you're in a situation where you need that money from the first month itself. Then in that case, you are basically left with no alternative but to start withdrawing. And at that stage, you will be faced with a short-term capital gains tax of 20%. And then if you hold it for more than 1 year, you get 1.25 lakhs tax-free. And all the gains that you're withdrawing after that are taxed at 12.5%. Now, the interesting part here is, if let's say someone is instead investing in a fixed deposit, then that entire interest that they get is taxed at their income tax level. So if that is high, you could be taxed as high as 32%. Whereas with an SWP, through an equity heavy portfolio, you are getting taxed at 12.5%. And even that 20% reduction in taxation can have a significant impact over the long run, because as I shared, right, you're not planning for the next 5-10 years, you're planning for the next 25-30 years. And one thing that I think a lot of people are discounting is that a lot of people who are in their 50s and 60s today are going to live for much, much, much longer. So you don't want to be in a situation where you're 85 years old and you don't have any money left at all. So purely from that perspective, again, having SWPs, that's another added benefit. The taxation becomes favorable for an equity heavy portfolio.
This is where I want to take some of the queries that have come through. And you see the number that that is on the screen right now. If you've got specific questions on mutual funds, then I'd encourage you to write in, because we've got a few that have come through that are very interesting. The first one is from Raj, and he's saying that he wants to invest 1 lakh per month. The objective is to build a corpus which he will need in the next 3 to 4 years. But the purpose is very interesting. He wants to use this for the registration of a flat as well as for the interior expense that he will have. So essentially, he wants to make a down payment for this. Shalini, it's very, very interesting, because he's pushing his requirement for buying a house down the line, and he wants to reduce the amount of money that he will have to borrow, and it's a very good financial plan. Now, to that end, I think the objective will be to accumulate as much money as possible so that the amount that he will have to borrow will be less. So how should he go about investing this?
So for this particular investor, the time horizon is very specific, because this need in terms of the amount as well as when he would require it cannot be stretched beyond a point. And unfortunately, with pure equity, there could be a time that exactly when he requires the money, it's possible that markets have hit a very bad phase. And in usual terms, one would continue to stay invested for markets to recover. But unfortunately, this investor would not have that luxury. So my recommendation, and these are personal views, of course, is that the allocation should go to safer assets. And of course, I'm saying that these could be hybrid in nature as well. Some of the categories that come to mind are, equity savings schemes, potentially hybrid, conservative funds. On the debt side, it could be a medium-term debt fund, which has a 3-4 year, residual duration to the portfolio, and could also be arbitrage funds. Now, these are all categories which either have some or low or no element of equity at all. But from that perspective, if you look at even an equity savings fund, which generally would have maybe 30 to 40% equity, the last 1 year in equity has been great. And these schemes have delivered, say, 16% return in a 1 year basis. But if I look at the longer term period, that goes down to maybe 8-9% return. So on a 5 year basis, I would say, to expect this category, it would probably give you 10-11%. So if I look at these 3-4 categories that I mentioned, on an average, an investor, if he wants to look at playing it safe, would be able to generate a range of anywhere from, say, 10 to 12% return. Like I said, with equity, if he's hit by a sudden adverse situation, he would not be able to fulfill the specific goal that he's planning for. And just to put some numbers out there, if the investor puts in 1 lakh a month for 4 years, at 8%, he would have approximately 57 lakhs at the end of this period, close to 60 lakhs at a 10% return, and maybe about 62 lakhs at 12%.
Wow.
So if his goal number is higher than that, he may have to go more towards the equity allocation, because clearly if he goes the very safe route where he's getting, say, 6, 7, 8% from hedged or fixed income strategies, he may not have that magic number that he requires to fulfill the specific goal. So somewhere working backwards, he'll need to figure out how much is it that he needs at the end of the day, and perhaps go slightly up the risk curve.
So I'm glad that you spelled that out. I'm actually very tempted to call Raj just so that he can say, but wait, I'm okay with staying more than 4 years. I don't know if that's the case. So I'm going to take the liberty and say, what if, Udayan, what if he has the ability to say that he can push his goal by another couple of years if the equity markets don't behave the way that he anticipates that they would? Because one would say that the best way to accumulate and grow your capital is through the equity markets. So assume that he's going to put all of his 1 lakh rupees into equities, and he is flexible to say that if something occurs, I can push this down the line. How should he allocate his money?
So in that case, increasing the equity exposure a little makes sense, but again, not having an out and out equity portfolio. Because again, if towards the end, towards the last 2-3 years, if the markets are not doing well, the portfolio goes down by 20%, he has lower money now available with him. So in if you purely look at data, and I think that's where it gets kind of tricky because statistics can mask everything. But in the Nifty 50, if you have had an SIP for 4 years, you have never lost money since 1999. Now, that doesn't mean Raj should go ahead and invest the entire amount in the Nifty 50 portfolio, but history may not repeat, but it rhymes, as they say. So in this case, I would personally lean towards balanced funds because it's the fund manager's headache when you're investing in balanced funds, how to tweak the allocation between stocks and bonds, maybe multi-asset funds. Once again, so you get stocks, bonds, and a little amount of gold and real estate in that particular investment. But I think anything about 6 to 7 years is when you want to start looking at a more equity heavy portfolio. Anything under 7 years, you want to have 30-40% in safer assets because again, markets are unpredictable.
That's a fair point. And by the way, we spoke about SWPs or systematic withdrawal plans earlier on in the session. Systematic transfer plans are another very strong method of allocating your resources. And remember, if you have a specific goal, as you near the goal, perhaps it's a good idea to start STPs from equity into a safer asset class. We'll talk about that on another day. I want to take the next question, which is very interesting. Vikas Gorkha, who's 50 years old, is saying that he missed the opportunity to invest in the new fund offer of Grow EV Fund. What should he do now? Shalini, not necessarily speaking specifically about the Grow EV Fund, but does an investor miss anything really if they miss out on the NFO? It's not like an IPO, is it?
No. So I think that's a common misconception. And I think this is a great sales and marketing tool that the industry, uses to garner a corpus. But, if you think about it, the listing gains concept, which is there when people subscribe to stock IPOs, is something that just does not exist in mutual funds. So I would say this investor has clearly lost nothing. If I were to take an example, had he invested in the NFO at 10 rupees and after 3 years sold his holdings at 15 rupees, he would have made a 50% absolute return. Now, suppose once the NFO reopens as a normal open-ended scheme and he buys, say, a unit at 20 rupees, which is the prevailing NAV, and he sells it after 3 years for 30 rupees, he still made a 50% return. So I think somewhere nothing is really lost. In fact, I believe personally that there is a risk of investing in an NFO because you don't really see any track record of that particular fund manager for that particular strategy basis which to go on. So I always, prefer to invest in something that has a good 3-5 year track record, and you can always buy into it. And a last word of caution, I would say for Undus investors have already fairly large diversified portfolios. Sectoral funds, again, do come with their set of risks in terms of being extremely volatile in case there's something negative happening either from a particular industry perspective. And they could see a lot of volatility and sharp drawdowns in their portfolio. Better to leave it to fund managers unless you know that sector very well. They can decide which is the best sector to be in. Yeah. Or you could put 10-20% in sectoral funds.
Okay, to that end, it's probably the last question we're going to be able to take today. It's from K. Kishore Kumar, and he's 60 years old. He's asking about the HDFC Defence Fund. Honestly, it was something that garnered a lot of interest today, and they shut off lump sum investments very, very quickly. They have, in fact, shut off fresh SIP flows as well because of the corpus that they have, or rather the pool that they have, and the way that the underlying assets have performed. We've got this viewer, Kishore Kumar, who's investing in SIP of 5,000 rupees in the defense fund. He's asking we should go ahead or should he move it to something else? What do you think?
So once again, if the SIP amount is much larger, and I'll give you a specific example, if the SIP amount is anything less than 40 to 50,000, then investing 5,000 in a sectoral fund may not be the best idea. And the reason for that, once again, is concentrated risk. But if I were to put that down into specific numbers, so 1 out of 4 funds that tends to perform well over a 3-year period is not a good performer for the next 3 years. So generally what happens, so HDFC Defence Fund has gained over 100% in the past 1 year. So naturally, when people want to invest, they'll filter funds based on past performance and they'll invest in the top performing fund. But invariably, once they invest in it, just because everything kind of is cyclical in the market, that fund doesn't perform well and they get in at a high price and now they're at a loss in some cases.
Yeah.
And a very specific example, if I have 30 seconds, Alex,
yes,
is the value category of investing, which is the value style of investing popularized by Warren Buffett, Benjamin Graham. that has been the best performing strategy since 2021. Okay, over 50% returns in several years. But guess what? In 2018 to 2020, that was the worst performing style.
Yeah,
There
it's
you
a fair
go.
point. That's a fair example and also well answered. Thank you so much, Uday and Shalini, for taking the time for speaking to us on the Mutual Fund Show. And viewers, well, hopefully this conversation has been beneficial to you. If it has, let us know in the comment section and do stay tuned. Lots more coming up on NDTV Profit.